Good morning, everyone. Again, welcome to the latest in our private client and entrepreneurial business webinar series. This time on the subject being business sale or exit. Patrick can't join us today, unfortunately, so you're stuck with me introducing, and I'm joined by my colleague. I'm James Kipping, as hopefully you probably know, and I'm joined by my colleague Tony Medcalf, also a tax partner at MHA. I'll quickly run through what we're going to cover. We've got quite a lot to cover, so I'm going to make this introduction very, very brief and then hand over to Tony. Tony will do the first three sections on the agenda here in looking at preparing your business for sale, business asset disposal relief, also, well, some of you might know that as entrepreneurs relief as it once was, then looking at how we how you can incentivize key employees within the business. I'll then cover the next four sections looking at, well, what are you selling, who are you selling to, are you selling shares or assets, in terms of who you're selling to, is it a third party, is it internal management or even family in the case of owner managed businesses, and then finally I'll look at the types of consideration that can be received when selling your business and how each type is taxed, and finally Tony will finish with some pre-sale planning opportunities. So without further ado, I will hand over to Tony for the first few sections.
Thank you, James. Thank you. Yes, so effectively when we're looking at preparing your business for sale, it's a long-term project, and really it's about making sure that everything's in place and that we have the adequate time to make sure that we have all the reliefs and structures available. So really we're looking now for a sale process that's going to be in the next 3 to 5 years. So very much a case of get ready now, understand what your options are. So what I wanted to just cover off was as James had said, is making sure you maximize the reliefs available. Principally capital gains tax is the relevant tax in relation to sales. So how do we make sure that we minimize that liability? Just have a passing thought about inheritance tax, because obviously that is the other tax that's impacted on a company sale, where assets that have previously got reliefs under business property relief are then turned into cash. So just a brief mention of that. I know that James will be talking a little bit more detail than that. Obviously, so therefore, just having a look at the share ownership structure and in particular how business assets disposal relief impacts on that shareholding structure. Make sure we maximise that across the shareholder base. In the case of owner-managed businesses, across families, those members of the family that might be working in the business or maybe not at the moment. Then thinking about beyond the sale, which is the idea of where do we want our wealth to be, and therefore think about trusts. As always with a company sale, as the main shareholder director, the owner of the business or the owners, you've got to look to make yourself redundant. Otherwise, you are tied in for a number of years after the transaction to make sure that the purchaser sort of maximises that best value. So how do we make ourselves redundant? Well, we've got to incentivize key employees, get those management structures in place, and therefore looking at how we might do that. Then we just look at the business structure, and then finally, I will touch at the end of the presentation on property. Sometimes purchasers are somewhat ambivalent about whether they acquire property with the business. So just some thoughts on that. So next slide, please, James. Thank you. So just I'm sure you all aware of BADA, which used to be Entrepreneurs Relief, but just for purposes of clarification. It's ever more relevant now, given that the lifetime limit for individuals has been reduced from 10 million down to the 1 million. So it's ever more relevant to make sure that we maximise that across families and shareholders. So what are the qualifying conditions? Well, we need to satisfy these for at least 2 years before the disposal. So again, this is the point about looking forward and a timescale beyond that 2-year period. So the company must be a trading company or the holding company of a trading group. The individuals must be either officers or employees of the company, and I'll just talk about that a little bit later. The individual must hold at least 5% of the ordinary share capital, the voting rights of the company, and they must be beneficially interested in 5% of the profits available or 5% of the proceeds unwinding up. So that's about making sure that the nominal share capital and the rights to individual shares are monitored at this stage, so that the likelihood of BADA not being restricted or disqualified as a consequence of an oversight. So part of the review now is to make sure that the shareholdings and their particular entitlements are qualified for that relief. So in particular, for those members of staff, key management that might actually have some shares at the moment, make sure that employment status is satisfactory. I mean, obviously, everybody that's paid through the payroll and a commensurate level of remuneration, well, they're fine. But there might be other employees that might actually work part-time. So in a lot of those instances, having a contract of employment in place to solidify their employment status would help, and obviously having that in place to make sure that HMRC don't question that anybody that's not an officer, a director of the company, but is relying on the employment status is not disqualified. Those people that are not employees, yet generally family members, then obviously it's one to look at is whether they are made directors, and those are company house directors appointed and registered at company house. Obviously, one needs to think about responsibilities and fiduciary duties of those directors. However, in groups of companies, if you've got a group of companies, it's often possible to introduce a directorship for a family member in one of the companies that might not be the main trading company. It might be a holding company, it might be a property company within the group. So it's worthwhile just investigating that idea as to whether those directorships can be in places where they're not too onerous for the particular individual. And then obviously shareholdings amongst family members, and that's about whether really looking forward to think that post sale, what would one want to do with that consideration, and as a consequence, is there any thoughts that we might introduce family members or other members into the shareholding structure at this particular time to ensure that we satisfy all those conditions, so that they can accrue their right to BADA and the first £1 million at 10%, as opposed to the main rate at 20%. So once we've looked at the shareholding structure, and I briefly mentioned, I'll just go back to the point about trust. What I was talking about there, and as I said, James will talk about this in a little bit more detail, but principally what we're looking at is that if we have maximised our entitlement to BADA and maximise the 10% rate across the shareholder base, we might have surplus proceeds that we might be looking forward and thinking, well, actually, for inheritance tax purposes, I would like the date of gift of those proceeds to be earlier, but also actually give more away than I might be able to in relation to trust restrictions when I've received the cash. So always consider, is there a possibility of actually putting some of the shares into trust now, so that the proceeds will fall into the trust on sale. So then just moving on to incentivizing key employees. As I say, important that we make sure that we get the right people, the right structure to drive the business forward. That's a key business point. Enterprise Management Incentive Scheme, I'm sure you've all heard about it. It's a very, very, very good option scheme available, very flexible. It's been around nearly 20 years now. So it's a tax-approved share option scheme, and it's designed to encourage employee ownership of companies. It's designed mainly for small and medium-sized companies, and the key part of the legislation that it's actually there to incentivise and retain specific employees, principally key management personnel. As I said previously, it's very flexible. You can actually set the parameters of the option in relation to performance criteria, accruing different percentages, increasing percentages over a period of time. You can do that individually to an individual, so it doesn't follow a set of scheme rules that everybody has to slot into. So it really depends on on the circumstances of the individual. So it is very, very flexible. And the principle behind the option scheme is that if it's done right and they are granted when the share value is quite low, obviously the intention is to incentivize that management team to grow the business, then they would expect to receive more of their proceeds at the capital gains tax rates and hopefully most of it at 10%, but at 20% if not, and that is substantially lower than the higher rates of income tax that we have at the moment, which is 40 and 45. So what is a share option, specifically under the EMI? It's a right to acquire a specified number of shares in the company at a future date at a predetermined price. So we're setting the price now. We're not actually giving the key staff shares at the moment. We're giving them the right to receive those shares. So at this particular moment, there are ways to protect against their leaving the business without having to have very detailed shareholder agreements. So again, there's another benefit there that they know that they've got some capital value in the future. However, it's not too difficult if things don't work out to undo. Are they going to be new shares, or is it going to be a fresh issue of shares on the exercise of the option, or are they going to be options over the existing shareholders? That again provides flexibility that certain shareholders might not want to, or might want to do a lower proportion than their requisite amount. So it's very, very flexible to give that incentive to key staff. So what type of shares are they? They can be the same shares that the existing shareholders have, or they could have a hurdle. Almost the current owners can say, well, the business is worth X million now, and I'm quite happy for you to have a share of the growth above that, as opposed to a share of the total value, and therefore we introduce a hurdle. So again, quite easy to introduce that and quite flexible. So when's the exercise date? Is it immediately or certainly in a short period of time? Are the performance conditions on sale, or can they just be on exit only? Well, they can, and a lot are actually just there for exit only. So again, that means that the existing shareholders don't have to concern themselves too much about minority shareholders in that instance during the operations of the business. So, and then finally, what's the exercise price? Is it the nominal value, or is it the market value, or anything in between? So what's relevant? What are the conditions? So there's company conditions and there are employee conditions. We need to be a trading company. There are certain businesses that are disqualified. There's a list of them, follows the EIS qualifications, primarily property businesses, but there are other businesses that's also relevant to that. But obviously that would be something that we would review. It can't actually be in a subsidiary. It needs to be in the holding company of a group or a standalone company. So the share options must be in the top company. At the time of the grant of the option, the gross assets of the company or group mustn't be more than 30 mil. And the employees' numbers can't be more than 250 on a full-time equivalent. So on the employee side, well, they must be an employee of the company or a member of the group. That goes without saying. They do need a work commitment of 25 hours per week, more than that, or if they have other jobs, then at least 75% of their working time. And they're not really to have a material interest. So material interest is described as somebody with in excess of 30% of the ordinary share capital of the company, including other options that they have. Next slide, please, James. So what's the tax implications? Well, as I said previously, the price of the options, i.e. what price do we allow the employees to buy into at this particular stage, it can be set at any value. Yeah. On grant, actually the time when you give the piece of paper to the employee and say, you are now entitled to that option to give you that number of shares in the event of that happening, there is no tax or NIC at that particular point. On exercise, well, exercise could be at a point before sale, or it actually could be on sale. So if it's before sale, there is potentially an income tax liability on the individual at that point, in the event that the price that they pay for the shares actually is lower than the price that existed for those shares at the date of grant. And you can agree all this with HMRC. There's a pre-clearance facility to agree what those values are. So for example, if the current share price is £1 and you allow an employee to take an option over the shares and not pay for them, then on that exercise, there's an income tax liability at that point on the difference of that £1. However, obviously, if they're at £1 at the time, then there's no income tax on an exercise. Now, for those that are exercisable only on sale, at that point, they are what's termed readily convertible assets, and therefore, effectively, any income tax element then needs to go through the payroll and taxed through PAY and NIC. Once you've actually got to that point and the individual has received their shares or their consideration in that instance, any growth above that value at that time is then subject to capital gains tax and is reported as normal through their self-assessment. And that's when they hopefully take advantage of the lower CGT rates. An interesting point for people with EMI is that there is no requirement for the enterprise option to require them to have at least 5%. So unlike a shareholder who has to own at least 5% of the ordinary share capital and have the voting rights, an EMI, again, flexibility prevails here. An individual can have a value that's lower than that 5% and still benefit from the 10% tax on under the BADA rules. Now, the period of ownership of the shares for BADA, which is the 2 years, obviously somebody who has an option, which is just a piece of paper that allows them to receive shares in the future, and if that option is only exercisable on sale, they would never qualify for BADA. So effectively, the legislation says that from the date that you get the piece of paper, the grant, that is the start of the qualifying period. So as soon as you get beyond the 2-year period and sale is beyond that point, then you should qualify for, the employee should qualify for BADA. Okay, next slide, please, James. And I think it's on to your stuff now, sir.
It is indeed. Thank you, Tony. Morning, everyone. So I suppose still in connection with preparing to sell, you must ask yourself, who are you going to sell to? And what is it you're going to sell? And in respect to the first question, what are you selling? In its simplest form, this question is merely asking whether you will sell the shares in the company or the trade and assets from the company. Now, it's usually more tax efficient to sell the shares, and I'll come on to that in a bit more detail in a moment. However, one thing to mention here, and it's the third bullet point there, is it may also be that you're only going to sell just part of the business, or you might be intending or aiming to sell different parts of the business to different buyers. For example, if there are several trades in a business, you might want to separate them into separate divisions or separate subsidiary companies in the years running up to a potential sale in order to maximize shareholder value. For example, shareholder value might be maximized by being able to report separately and streamline the brand approach and identity or what have you of each activity or product line or whatever your business is. And this sort of comes on to group structures that we discussed in an earlier webinar. And I suppose all I'll say here is you may recall that we explained that with careful planning, generally a group structure splitting out different aspects of a business can be created without significant tax implications. Now, once a group structure is in place, a trading subsidiary holding perhaps one of the businesses or one of the trades of a group can generally be sold without corporation tax applying to the capital gain. That's due to the substantial shareholdings exemption. However, in that case, the proceeds will then be received by the selling company, so still locked within that corporate group and may be reinvested into continuing activities within that corporate group. However, if the shareholders are looking to receive the proceeds of sale of part of the business personally as a capital receipt, subject to capital gains tax and BADA, as Tony has explained, you might pre-sale need to consider something like a demerger well in advance of the potential disposal. Now, again, we talked through the demerger process in an earlier webinar, but we explained that generally they can also be implemented without tax liabilities, although sometimes stamp taxes can be unavoidable. And a demerger will have the effect of either breaking up the group or company, but retaining the same share ownership in respect of each broken up aspect, or you could potentially partition a group where certain shareholders take different parts or proportions of the business. I suppose what I reiterate here is that planning should be undertaken well in advance of a disposal, particularly if you need to effect something like a demerger. There needs to be genuine commercial reasons for a demerger to obtain HMRC's clearance, and they're far less likely to accept that that's the case if it's clearly motivated by the shareholders immediately receiving a capital receipt on the sale or transfer of part of the business. So that's a long-winded way of explaining the first section of this slide. The second section is quite straightforward. In terms of who you are selling to, we will typically be considering one of either a sale to a third party, sale to management or employees, or potentially succession within the family group. So moving on. If you're looking at a sale, as I said, you typically be looking at whether you're selling the shares of the company or the trade and assets from within the company. Now, the sale of shares is usually beneficial for the seller for these reasons. They get capital treatment. They will usually benefit from BADR. That's 10% CGT on the first £1 million of gains and 20% thereafter once they've exhausted their BADA lifetime limit. There are also multiple options for consideration, including cash, deferred cash, earn-out consideration, based potentially on the future performance of the business, and paper consideration. Now that's loan notes or even shares in the acquiring entity. So it might be that we sell the entity but retain a small interest or what have you. And I'll come on to how each item is taxed in a moment, because that's a big part of the negotiation on the sale of a business. If, however, and this is the second part of this slide, if, however, the company sells its trade and assets, the company will first pay corporation tax on its capital gain, and then there will be personal tax when the proceeds are extracted. Now, looking at avoiding or minimizing those personal taxes, we have several options. We may retain the company as an investment vehicle. We may extract proceeds over time, but keeping dividends within lower rate tax bands. Rather than perhaps extract everything taxable as a lump sum, even if subject to capital gains tax, we might drip the proceeds out over time at the lower dividend rates, for example, at just 8.75% if you keep everything within the basic rate band. Or finally, the company could simply be liquidated by members' voluntary liquidation and funds extracted as a capital receipt. And those capital receipts will usually be subject to capital gains tax and BADA. But watch out here, just a quick word of warning that there are anti-avoidance rules to counter what we call, or so-called, Phoenix arrangements, which may kick in to charge liquidation distributions to income tax if the shareholder undertakes a similar activity in the 2 years following a liquidation. And one of the reasons for that liquidation was to avoid or reduce the liability to income tax. It's a relatively new provision and something we have little authority on, but clearly needs to be taken into account before a liquidation. And finally, on the sale of assets, purchasing companies are generally no longer able to claim a deduction for what we call goodwill amortization. And because of that, there's now less resistance to a share sale. So more often than not, we're dealing with share sales in this situation. Now, in terms of a third-party sale, a key consideration in the negotiation to a third party is the form and timing of consideration, which may take the form of one or more of the following. All cash on sale. We might have some cash immediately and some cash deferred for a period of time. We might have cash plus earn-out consideration based on future results. We might have cash plus paper of some form, as I said, loan notes or shares. And each of these forms of consideration has different tax implications, which again, I'll come on to. It's also quite common for the purchaser to require key personnel to remain in the business, certainly for a period of time following acquisition. And one of the key negotiating points often is, well, how long do you require the owner manager or the previous owner manager's input? And a seller might want any deferred consideration or earnout to be linked to, or I suppose certainly not extended beyond, their period of ongoing involvement within the business, because of course during that period they can influence the business. So lots and lots to consider when it comes to negotiating a third-party sale. However, as Tony kind of introduced when thinking about employee incentives and what have you, often an exit takes the form of what we call a management buyout. And that's where a company's management team purchases the assets and operations of the business that they manage. Now, this kind of internal sale can take several forms, often guided by the resources available to the business and the management team in terms of how they can acquire the business. And just running through the 3 points on that slide, the shareholder could sell their shares back to the company. So that's a company purchase of own shares. And on this type of buyback, the default position is that proceeds are treated as a dividend distribution, so not desirable for the seller. But if certain strict conditions are satisfied, they can obtain capital treatment. Now, the key conditions include that the company must be trading, the shares must have been held for at least 5 years, the shareholder can't continue to be connected with the company, and the buyback must be for the benefit of the company's trade. Now, if a buyback is considered, it's important that the business obtains clearance that capital treatment will be given in advance of the transaction. Now, quite often, a buyback is not appropriate, or we can't satisfy all the conditions. And as a result, the alternative, here on the second point, what we call a new co buyout, is probably the most common route for a management buyout. So that's where the continuing management team establish a new company, which in turn then acquires the trading company, providing shares to the continuing shareholders and the management team, and cash or deferred consideration or whatever form of consideration is chosen to the exiting shareholders. And in that consideration, the exiting shareholders should get capital treatment on their sales proceeds. The final point here is there could be a sort of combination of the above, and shareholders could also consider the sale to an employee ownership trust, or EOT, as on the slide here. I don't want to go into too much detail. It's not really my specialist area, and in fact, we could probably do a webinar on EOTs in its own right. But in summary, an EOT is a special form of employee benefit trust that was introduced in an attempt to encourage more shareholders to set up corporate structures similar to what we know the John Lewis model to be, of encouraging employee ownership. And of course, the aim is to facilitate that wider employee ownership. Now, from a tax perspective, the sale of at least a 51% interest to an EOT is completely tax-free. So it is something that should be considered in most situations, even if it's discounted at a later date. Now, as I alluded to at the start of this particular slide, a key factor in determining the most suitable option is often affordability. So a buyback, so that's purchase of own shares, would need to be paid in cash in full on completion. Whereas the NewCo and EOT routes, on the other hand, can provide much more flexibility and an opportunity for consideration to be paid over time and potentially from future profits. So far more flexible and very common in a sort of management buyout situation. Now, in terms of family, in terms of family businesses, owner-managed businesses, quite often the succession plan or the exit plan involves passing the business down a generation. So succession within the family. But it's still, in that situation, it's still possible for the traditional routes that I mentioned a minute ago to be used to facilitate the disposal of shares, and therefore the receipt of capital proceeds in the hands of the current shareholders. So I won't go over purchase of own shares and NewCo buyout again, but I will say that in terms of family, a straightforward gift of shares should qualify for what we call capital gains tax holdover relief. So there's no tax charged on the transfer. And it will normally also escape potential income tax liabilities under the employment-related securities rules by reason of an exemption for transfers in the normal course of domestic, family, or personal relationships. And Tony mentioned this, and another tool used in succession planning is the use of a family trust. Now, while the company is trading, the shares should qualify for business property relief, which means that the shares can be settled onto a trust for the family without inheritance tax charges. That's a really, really important benefit here. So then if the shares are sold, the trust pays capital gains tax at 20%, very, very rarely will qualify for BADR. And the cash then on a sale is held by the trust outside of the settler's estate. So we're avoiding a situation where a sale of a business dramatically increases the seller's estate for inheritance tax purposes. And just to provide a little bit of an example, I have a couple of excellent examples amongst our clients where business owners were looking for an exit, but didn't need to necessarily retain a significant portion of the anticipated sale proceeds for themselves. They had enough personal wealth that they didn't necessarily need the capital that was due to come in. And in some cases, I've had clients put group structures in place with the shares then transferred onto a family trust with no inheritance tax because they qualify for business property relief. The subsidiary company is then sold with the benefit of the substantial shareholdings exemption, so no tax is payable on the sale of the business. And the holding company is then retained under the ownership of the trust as an investment company for the benefit of the family for potentially generations to come. And without wanting to go into too much detail in the interest of time here, we can then go a long way to establishing a kind of remuneration or profit extraction plan whereby profits can be extracted for the benefit of the family annually at comparatively low tax rates. So that's probably a subject of a separate webinar in its own right. Now, my final couple of slides here are concerned with the structuring of the consideration. So, the nature of the consideration when you sell a company or a business can materially affect the resulting CGT liability. Now, how to cover these various sections, I suppose. It's common for part of the consideration for the sale of the shares in the target company to be in the form of shares or loan notes in the acquiring company or a combination of the two. The main reasons for this, it could be in the case of a management buyout, insufficiency of cash available to the buyer. So there's a need for some consideration to be deferred. Or it might be that the seller has a desire for some limited continued involvement in the business. Cash consideration will be subject to CGT, but where the seller receives shares or loan notes, as I've just alluded to, and certain considerations are satisfied, there's no disposal for the purposes of capital gains tax in respect of those shares or loan notes consideration. Instead, the original shares and the new holding of shares or loan notes are treated as the same asset, and the new holding inherits the base cost of the original shares. And in that case, no taxable gain arises until the disposal of the shares or loan notes at some point in the future. Now, that no disposal treatment is often desirable for the obvious reason that the shareholders should not be required to pay CGT until they receive, or rather until they realise their investment. However, you might have a situation where the shareholder, in respect of their ongoing holding, won't qualify for BADA on the eventual disposing of the retained holding. Now, in that situation, it's possible to make an election to disapply the no disposal treatment and pay tax now at today's rates on the market value of the shares received. So that's also a consideration if you consider that potentially CGT rates might increase. On to the second bullet point here, the tax treatment of loan notes depends on whether they're structured as qualifying corporate bonds or QCBs on non-QCBs. I won't explain the difference here, but sellers will generally prefer non-QCBs, and generally that should be accepted by the buyer. In the case of non-QCBs, the seller will only be liable to tax upon their redemption. Now, if the non-QCB is not redeemed in full, this will then be reflected in a reduced gain. So, for example, if the ongoing business is unable to, because of its performance, is unable to acquire those non-QCBs or redeem those non-QCBs, and the seller doesn't pay tax on the cash they don't eventually receive. If the individual will not qualify for BADA upon the redemption of the non-QCBs, similarly to how I described it a moment ago, they can choose to make an election to disapply that no disposal treatment and pay CGT with the benefit of BADA in the year of the disposal. I won't explain any more on that in the interest of time. I'm conscious that I should hand over to Tony. But the final point on this slide, cash consideration may be deferred, in which case the tax treatment depends on whether that cash consideration is ascertainable or unascertainable at the time of the sale. So let's say you agree a sale for cash, you know exactly what the cash is going to be, but it's payable over a period of time. In that case, the consideration is ascertainable. For example, it's a stated amount, but the right to receive the consideration is contingent or is paid in installments. Now, in that situation, the whole gain is taxed up front. So from a cash flow perspective, sellers must understand that the tax liability may be payable before some or all of the consideration is received. If the deferred consideration in this situation is ultimately not paid because the business gets into difficulty or something, then there is a provision to allow the selling shareholder to adjust their CGT liability downwards. Unascertainable consideration, that's the final, or the middle point of the slide here, is a little more complex. Now, this might include an earn-out, which is a general term covering any kind of mechanism where the purchase price is usually partially determined by reference to future performance of the company. For example, the seller might be entitled to additional consideration calculated as a percentage of profits above a certain level for a certain number of years. Now, in this case, where there is unascertainable consideration, there are two disposals for CGT purposes. The first disposal is at the time of the sale. So when the unconditional contract is signed, the proceeds at that point that are subject to capital gains tax are the ascertainable consideration, so any cash that's payable up front or anything that we know but it's just deferred, plus whatever the value of the right to receive future unascertainable consideration is deemed to be at that point in time. And then the second disposal is or perhaps there might be more than one other, but in this instance, let's just say there's a single second disposal. That's the disposal of the earn-out right itself when the further consideration is received. Now, the important point to note here is that if the only asset the shareholder retains is that earn-out right, no BADA is available on that second disposal, so when the earn-out consideration is paid. And on that note, I will hand back over to Tony for some pre-sale planning opportunities.
Thank you, James. I think it's just very quickly worth going back again to the point about use of trusts and giving shares into trusts now. It's not to be underplayed that, because the amount that one can put into trusts at a later stage, once one's received their cash proceeds, is limited to 325,000. That is going to be frozen for the next 4 years as well. And in fact, I think has been frozen probably already 10 years already. So it's very much, and it will be part of the next presentation where we talk about what do we do after sale. It's very much a thought of actually managing tax and wealth and consideration of share transfers into trust at this particular stage. So that's all I'll say on it, but it's very, very important to think about that. So just then turning to just an example of things that that one might consider. Purchasers are sometimes a bit ambivalent as to whether they buy the property. So if the property is owned within the company that they're seeking to buy and the business, they sometimes will accept it, they won't, and particularly if the property is actually quite valuable compared to the value of the business. So quite often we sort of think about, well, actually, should we just make that decision for them easier, provide when the sale is relevant for a sale of the shares in the business, and therefore that's just the trading business. The property is then elsewhere. If they wanted to buy the property, well, they could buy the property in a separate, property purchase from the in this instance a pension. So just talking through pensions and possibly the interaction with CT rates and their expectation of going up in the future. So I've just got an example here, just a simple example where we've got husband and wife effectively own 50% of the shares each in a company. Properties in the business, year end March 23, £400,000 profit. They've got existing pension pots, about 100,000 each, private pensions maybe, and the property's worth about 450 with a yield of 36,000. James, if you go to the next slide, please. So effectively what we do is that we have to create the right type of pension. So individuals need to either own a self-invested pension, a SIP, or more commonly for trading businesses, certainly family businesses, a self-administered scheme, a SAS and SSAS. So they effectively transfer into a qualifying pension fund. So the £200,000 that's coming, 100,000 from each goes into the pension fund at that stage. Next slide, James. The company then makes a contribution of 100,000. All individuals are allowed to put in £40,000 per year or have a contribution made by the company on their behalf. That is restricted if income goes above a certain amount of 210,000, but on the assumption that we're below that, then an individual has £40,000 per year. Primarily, if there's been no contributions in the previous 3 years as well, you're allowed to hop on to the previous 3 years as well. So in any 1 year when there's been no previous contributions, what an individual might be able to put £160,000 in. So in that instance, and I'm assuming that's the case here, company makes a one-off pension contribution into the scheme. So the scheme has now got £100,000 from the company and its previous 200,000. Next slide, please, James. We've got £300,000. A pension scheme can borrow 50% of the assets of the scheme, so it could borrow 150,000 in this instance, and that just happens to be 450,000. And I understand there are costs of acquiring the property, there'll be valuations that the trustees will require, the stamp duty that we need to consider, etc. Legal costs, but I'm just for illustrative purposes, I'm just trying to show that we've got the 450,000 in the pension, and what we're going to do is then enter into a transaction where the pension fund then acquires the property off the company. Next slide, please, James. It's always difficult, this one, on a webinar because I can't actually point out to the order, but if I try and explain it. So we've got the money in the pension scheme. The pension scheme acquires the property, so that the arrows are trying to show that the cash moves into the company, property moves into the pension. The company then has got an obligation then to pay rent to the pension scheme, so that the rent then goes into the pension scheme as well. Now, ordinarily, in that instance, you then would use the rental income over the ensuing years to pay down the bank debt that's currently existing in the pension scheme. However, if the business is cash generative, then my next slide, I'll just talk about the possibilities going forward. Next slide, please, James. So the timing can be impacted, and we're not so far away from this now. Corporation tax rates are 19 at the moment, but they're expected to increase to 25% from the 1st of April next year. So in that instance, one might think, well, actually, rather than just allow the rent to repay, is there an opportunity, do we have the cash in the business to then make further contributions? And would it not be better to make those contributions when we will get corporation tax relief at a higher rate. So exchange and complete on the property disposal now. If there's a gain on the property, that happens now in the current regime at 19%, and we pay the tax at that rate. However, if we then have surplus cash from April 2023, we might consider further payments into the pension as employer contributions to allow the bank debt to be repaid in full, and therefore get tax relief at 25% as opposed to the 19%. Okay, next slide, please. So, brief summary of that. What that results in is that, and again, what I'm trying to show here is that you've taken the property out, you've put cash into the company, which again, on an onward sale, is more amenable to a purchaser, because cash is easily usable and they're quite happy to pay a consideration for cash. So in this instance, what we've done is we've increased the cash in the company by 256,000, which effectively is the 450 received for the property. We've made £250,000 worth of employer contributions in, so that drops it down to 200. But we have then saved corporation tax at 19,000 on the 100 and 25% on the balance, the 150. So therefore, we've saved 56,500 of CT. The pension funds for Brad and Angelina have increased by 250,000, and the property is safe. It's in some respects it's safe away from the business, and the business is then in a position where it's quite lean. It's got cash. It's not got big assets that might not be desired by the purchaser. And I've just sort of noted there, principally, when you're paying the rent out, you might have been making contributions for the directors in the future, but the rental effectively replaces that and provides a return in the pension for it to grow in a tax-free environment. So just then that then leads on to my final slide, which is effectively considerations again about when you're thinking about selling your business, maximizing the proceeds that you might receive at the lower tax rates as opposed to higher. So the obvious example of that is that we make money within the company, and normally we might be taking it out in the form of dividends. Well, if we retain that money, or indeed if we do draw it out on director's loan account, and we may suffer a corporation tax, the Section 455 liability for overdrawn director's loan accounts. But principally what I'm meaning there is that you're trying to retain the value in the company rather than extracting it out of the value of the company by paying dividends. Well, there's an obvious difference in tax rates between CGT, which is either 10 or 20, and the higher rates of dividend taxation, which is, now that the national insurance has taken effect, is not far short of 40%. So there is an incentive to retain cash within the business so that when you ultimately sell the shares, it can be added onto the consideration for the shares on a normal cash-free, debt-free basis. And as I say, purchasers are quite happy to buy cash as well as the enterprise value, because they can immediately get access to that cash when they take control of the company. Now, in those instances, that's fine for me to say, well, retain cash within the business. However, there is always the consideration and the concern that I don't want to continue to expose my existing profits until I ultimately sell to business risk. So there's always then the consideration of, well, do we impose, if we've not already got that, if we've not already got a group, do we impose a holding company and just move the cash up into the holding company, retain it as cash, and then obviously when we come to sell, just sell the whole group, which includes the holding company. We do have to make sure, be mindful in all these instances that we don't have too much of cash, but I mean, that's again is something that we would look at, and as part of the plan, we understand what those levels are, and we'll direct you as to how much you can retain in this cash, as a comparison to the enterprise value, and then still make sure that you get the favourable tax rates. So, as I've said, we do need to make sure that we watch for the impact on BADA in relation to retention of cash, and also inheritance tax. But primarily, it's quite a well-used tool, and again, it's something that requires a little bit of planning, because it could happen over a number of years. So I think that's me wrapped up now. Thank you, James. And I think that we're now available for questions, if anybody has any.
Thank you, Tony. You've actually just triggered one almost instantly. It's from a listener who says, we've got a lot of cash in our trading company, probably will sell it. You've just referred to some problems. A bit more detail would be very helpful, if I may paraphrase the question.
Yeah, generally, I mean, when we're looking at, it's the interplay of BADA. I mean, for BADA, for the 10% tax rate, then effectively you must be selling a trading group or a trading company. And in that instance, you look at a number of tests, and you look at them all in the round, and you don't provide any more weight to any one than any other. You sort of look at it over a period of time, and that's predominantly, you know, what are the assets of the business? So cash is an asset of the business. What's the management time? What's the turnover? What's the net profit? What's the gross profit? So you look at all those tests, and you sort of say, on the face of it, is it a trading group? And if 80% of those general activities are in trading, then you have 10% tax, off you go. Sometimes companies have surplus cash. Now, they might have surplus property that they might actually rent out. They might have made profits in the past and then use that to provide a portfolio of property. In that instance, then, you have to look at that asset and sort of see whether it falls foul of the 80-20 test. Cash itself, generally, if the cash has been made from trading and is retained in a fairly liquid form, in relation to capital gains tax, is not generally queried. It can be for inheritance tax, yeah, but here we're talking about, does it have an impact on capital gains? Obviously, if you then use those proceeds to go and put some money into the stock market or buy an investment portfolio, whatever, then that's a different thing. But it's really looking at the relevance of where the cash came from. Is it still in a liquid form? Could it still be used within the business? Yes, it could. And therefore, and looking that in the round as to whether it's very, very excessive in comparison to the enterprise value. So that's broadly what I was trying to get to, if that answers the question.
It does, thank you very much. A couple of questions with an international flavour. The first one's very straightforward. The second one's a bit more controversial, I think. A company has overseas shareholders, so does this cause us any complications when we sell? And the second one, can I or should I become non-resident in the UK before sale?
Shall I start off?
Yep.
Non-resident shareholder shouldn't be a problem in itself, other than to say that those non-resident shareholders will need to take advice in the jurisdiction in which they are resident, because they know what may well have tax liabilities there. On the whole, non-resident shareholders shouldn't have a liability to UK capital gains tax on a disposal, which leads nicely into the second question: should I become non-resident to avoid capital gains tax on a disposal? And that's something that people do, and there are various jurisdictions that that are attractive in that regard, that wouldn't tax the disposal of UK, or rather shares in a UK company if you're resident there. The point to note is, well, two points to note. One, we've got a statutory residence test in the UK, so we can definitively say, whether or not someone will be non-resident given their particular circumstances. So that's good in many ways. Second point, though, is there are temporary non-residence rules. So if you become non-resident and then become if you become non-resident and then whilst you are non-resident, sell your UK trading company, for example, and then if you become UK resident again within a period of, say, 6 years or 5 years, so I think you've got to be out for at least five complete years. If if you come back within that period, then any gains you've made during the non-resident period will be subject to capital gains tax on your return. So it's not simply a case of becoming non-resident for a year, selling your business and paying no tax. You've got to be long-term non-resident to avoid those temporary non-residence rules. Does that cover everything, do you think, Tony?
Yeah, we had the good old days, didn't we, where we used to, when tax rates were at 40%, we used to have situations where people would go over to Belgium under a contract of employment to evade it for only 12 months. Yeah. We don't have that now. What was the ER at 10 million sort of took a lot of these questions away. It's now come back, very much more prevalent and much more questions that we have. Generally, yes, it's still an opportunity now. You have to look obviously at where the jurisdictions are that you want to go, whether you're happy to stay there, because 5 years is a long period. But we do now, under the statutory residence rules, have quite a definitive set of tests now that says you're either resident or you're not resident, or if you're coming back to the UK for certain periods of time, depending on how many ties that you retain with the UK. Do I just fall within them those requisite days? So effectively, you're looking at the number of midnights that you spend in a country, and that will vary depending on some of those 5 tests that you need to satisfy. So it is quite straightforward, and it's just a case of then monitoring it to make sure that you don't fall foul of those rules.
Thank you. Yeah, so the questions are flooding in. There is one more with an international flavour, actually, that's just come in. It says, are there any matters to take into account when selling shares to an overseas company buyer?
Other than I've had a few instances with US purchasers where they don't get sometimes the points that I've talked about, where you do it on a debt-free, cash-free basis. Other than that, you're then looking at, well, what happens to the residents of the company? Usually, your company, if it's UK incorporated, it's UK taxable for corporate tax purposes. Obviously, the imposition of an overseas purchaser could then have a dual residence situation. So then you then have to look at whether there's an exportation of that company. But generally, it doesn't provide too many difficulties in that. And that would be my comments on that.
Thank you. At the risk of making sure you don't tell anybody off, we're thinking of selling our business between September 23 to August 24. When should we start to prepare?
Last year.
Yeah. Certainly now, definitely now. But yeah, you do need a period of time to think about that. All this 2-year time limit we talked about on the capital gains tax, we're already in it, aren't we? So yeah, now.
I think the reality is that it depends on the business, doesn't it? You could be very well structured and there's not a great deal that you need to do, but the situation could be very different.
Right, thank you, James. You touched on a particular form of CG relief. We sold the business, the shares in the company, in May 2019 on deferred terms. I think that just means cash deferred terms. Yeah. Looks like we might not be paid. Do we get relief?
Yes, you do. So if the consideration was what I referred to as ascertainable, so ascertainable deferred consideration, you will have been subject to capital gains tax on the full amount of consideration at the time of the disposal. If some or all of that deferred element is subsequently not received, then you can make a claim. I think it might be a claim outside of a tax return. I can't remember. It's very rare we do this, but certainly you can make a claim to adjust the CGT computation and therefore the tax that has been paid.
Thank you. There are quite a lot of questions on I've sold for cash, what do I do next? But I think we'll have to probably leave those. But James, you did mention SSE, and and someone's just doesn't seem to be familiar with it. So if you wouldn't mind, just very briefly.
Yeah, SSE is where there is a corporate shareholder. So take a straightforward group situation. Say you've got a holding company with a trading subsidiary. That holding company obviously owns the trading subsidiary. If the holding company sells that trading subsidiary, having held the shares for at least 12 months, I think the strict condition is it needs to have held at least 10% of the share capital for 12 months within the last 6 years or something. But the principle is, in that situation of a corporate shareholder selling trading subsidiary, there is no corporation tax charged on the capital gain arising to the holding company. So in that situation, the cash proceeds arrive in the holding company with no tax. And then the question is, well, do we want to extract that? How do we extract that? And that's when we went on to talk about potentially liquidating the company to extract the proceeds with the benefit of, hopefully, capital gains tax and BADA.
Yeah, and that again is actually how diverse would we like the cash to go around the family or the shareholders, and those are all what substantial shareholding allows us to do is actually not suffer that tax liability at the corporate level and make a decision as to what we do, which then leads into almost like wealth planning and inheritance tax planning. What do we do with the money? Do we suffer the tax now and distribute it for people to spend as they do, or do we want to keep it all together, maybe create a family investment company, which is what James referred to in relation to the trust? So it does make matters a lot more flexible than it used to.
Thank you.
We've just gone past 11. I mean, I'm happy to take more if there are any, or we...
Well, yeah, if I might pester Tony. Tony dwelt on EMI, and the question has come in, are the other scarce share schemes useful in this context? And also, how else might management be incentivized? Cash bonuses on sale have been suggested a couple of times.
Yeah, I mean, management can be incentivized in two ways. One is being paid, and the other one is to actually receive almost what we call a slice of the action, which is the capital value. That capital value can form, can actually just be paid as a pre-sale bonus to staff. So the EMI almost tries to deal with that, in that it gives them that ability to receive some of those proceeds, but actually try and access the lower rates of CGT. In the form of other option schemes available, there are other option schemes. I mean, there are unapproved options. So, you know, an option scheme is simply the ability to give somebody the option to receive shares in the future. However, if it's unapproved, well, it's effectively treated like a bonus. It's just subject under the employment-related securities legislation to PAYE. That is overly favourable. That's generally more suitable to larger businesses, you know, so quoted companies, etc., where the shares are more liquid. In OMBs, obviously the liquidity of the shareholdings is an issue, and it's generally only liquid primarily on sale. But then there are other, like, you know, there are CSOPs, there are qualifying option schemes, which again are more suited to larger businesses where there is a fluidity of ability to sell shares under option, or sell shares that have been received under option, and they're taxed again, subject to certain minimum £30,000 limits to income tax.
Thank you. Got an apology with this question. Apparently someone missed part of it. If you are granted ESO EMI shares free, assuming that's okay, if you kept the shares until the company is sold, does BADA apply, provided the relevant conditions are met?
Yes, I mean, the point there is, and just to use it as an example, if the share price at the moment, and interestingly with options, is that when you work out what the share price is applicable to an employee, you might say the company is worth £1 million. If you want to give them 10%, a 10% shareholding of £1 million company is not worth £100,000. It's probably worth £20,000 to £30,000, because because it's an unquoted company, there's an illiquidity to those shares, and therefore HMRC generally accept that, well, they do accept that there's a discount to the value of those shares, because at the end of the day, you can't sell them to anybody else other than existing shareholders more often than not. So you might, in that example, have a situation where the company's worth £1 million, you get 10%, but actually the value's only £30,000. Yeah. If you don't pay for those options, so you're not actually required to pay, when you come to sell, let's say we've sold in 5 years' time and the company's worth 2 million. Yeah, just as an example. So that 10% stake then is worth 10% on full sale value of £2 million, which is £200,000. So how's that taxed? Well, on that sale, the amount that you didn't pay as to the market value when you got the grant, i.e. the difference between 0 and 30, that's taxable to income tax, okay? The growth from 30,000 to 200,000 is actually taxable to capital gains tax, and therefore, as long as you've qualified for, BADA through the other conditions, that will be taxable to CGT at the more preferable rates. So that's generally how it would work, if I've explained it. Okay for everybody?
Yep.
Thank you. Yep. Another question just popped in response really to what you've been saying. Is there a problem with giving employees shares, which people write books about that particular topic, but if you wouldn't mind just very quickly running through one or two of them.
I suppose perhaps it might well be one for Tony, but I'd jump in and say, well, that's, I think one of the benefits of the option schemes is you're not necessarily giving them shares, and I think that's why the exit only EMI scheme is so popular for owner managed businesses, in that a business wants to incentivize key employees to give them a stake in any future disposal, to incentivize them to help grow the business and work towards a disposal. But at no point until the exit are they actually a shareholder. So you haven't got the problems associated, or potential problems associated with employee shareholders. Anything else you'd add, Tony, in respect of what the problems might be if you do have employees as shareholders?
Well, that's very relevant, and that's what I touched on before. You do need the structure to be able to get those shares back, and often you look at good leaver, bad leaver provisions. What price do I pay, depending on what the circumstances of a shareholder leaving are, because owner managed businesses, and controlling shareholders generally want to make sure that those shares don't go to people that are not incentivized, not part of the business. So that's the commercial side to it. Giving an employee some shares, then we're immediately into a situation where actually we have to think about what value have we given them. So that point about valuing the shares at this particular point now, we have to deal with that, and then we have to tax that accordingly. And we don't have, unlike an EMI option scheme, with EMI, we do have the ability to agree share values with HMRC at the start, so that we all know where we are with our tax in the event of future precipitation of proceeds on sale, etc. Whereas if you just give them shares now, it's self-assessment. So you can't pre-agree the value with HMRC. So you can have a best guess of what the values are, but it's always subject to HMRC agreeing, which could end up being a higher figure, and therefore the tax liability payable by the employee receiving it through their employment could be higher. So that's again is a bit of a disadvantage as opposed to giving them EMI.
Thanks, Tony. We've gone to just about 10 past 11, so we probably ought to wrap up. If there are more questions, we're obviously happy to contact you afterwards and speak to you, or just simply answer your questions. Thank you all for joining this morning. I hope it's been useful. I believe the next webinar will be sort of post-sale, kind of what you might do with your money, and that'll be probably more from a wealth management perspective, or certainly a kind of joined up tax and wealth management approach. We'll send out the invites in due course as normal, and look forward to as many of you as possible attending. So thanks again.